In today's video, we will find out if Dollarama is a good investment for your buck, and we will begin right now. As a financial minimalist, I am very familiar with Dollarama as they always have the cheaper options I love. Try decorating a tree for less than $100 at a bigger chain store. Holidays, parties, general house, and pet supplies, they do have it all. With inflation and the fears of a recession, a lot more people need these cheaper options just to make ends meet. And this does bode well for Dollarama. In many ways, they are poised to do well in a recession, and we will have to see if that makes them a great investment for our portfolios. Before I deep dive into Dollarama, let me know in the comments if you are invested in them. I know at least a few of you are. I also want to very quickly thank you guys for being here. If you are looking for free financial content, you're definitely in the right place. If you have not yet subscribed, take a second and do that now to support the channel. Dollarama was founded back in 1992 in Montreal, where it is still headquartered today. They phased out another dollar store chain called Rosie S. Inc., which was owned by the same family. That, of course, made it very easy for them to expand up to 44 stores, converting those Rosie S. stores into Dollaramas within their first year. The popularity of the chain allowed for steady growth, and today we have more than 1,300 stores with plans to have 2,000 stores by 2031. That sounds great, but you all know the fluff is just the fluff, and we need to look at the numbers. Dollarama IPO'd in 2009 with a ticker of DOL. They have a very nice market cap of $22.24 billion, and their beta is 0.82, so they are a little less volatile than the market average. In fact, over the last 3 months, they were less volatile than roughly 75% of the stocks on the TSX. Their earnings per share, or EPS, comes in at 2.33, and their diluted EPS comes in at 2.30, which is absolutely great. I love a company where the possible effects of non-public shares being sold is minimal. When we look at their PE ratio, price to earnings, it is 31.7, which is high compared to other retail chains. Canadian Tire, for example, comes in at 8.5, and Pet Value is at 20. The average in their sector is 19.6. Normally, I would say that is an indication that Dollarama is overvalued, but are they? Sometimes a high PE ratio can be an indication of fast growth. In the last year, Dollarama's earnings rose by 17.5%, and they are currently forecast to increase their earnings yearly by 12.3%. This is not too shabby, and I would define this as a lot of growth. When we jump into their balance sheet, we have a total of $4.252 billion in assets. When we look at their liabilities, they come in at $4.193 billion. $1.9 billion of that is straight up debt. At the beginning of the year, that debt was coming in at $1.890 billion. So they have had a small increase so far this year. What is nice is that their debt is well covered by their operating cash flow, and there is absolutely no concern of them not being able to pay off the interest on their debt. I would, of course, feel better if their assets were a little higher in comparison to their liabilities, as it would not take much to reflect a negative shareholder equity. However, considering their expansion plans and the growth they have already experienced, I think they know how to walk that edge very well indeed. Now, I want to look at what is in it for me as an investor. They do have dividends, though they are not really a huge dividend play, as their yield is only 0.289%, which comes in the form of a quarterly dividend of 5.5 cents. This does make sense, as most of their profits are funneling back into the company's growth. When we look at their growth potential, in 2021, their share price rose from $51.99 to $64.49, which is a return of investment of 24%. Add in those dividends, and we have a total return of 24.3%, which is pretty awesome. In 2022, we started off at $64.49, and at the time of recording, we are now at $77.33. So in a bear market, we have an ROI so far this year of 20%. Holy banana bread! This is a company that has 7x'd their share price over the last 10 years. Consistent growth has been a constant, and that certainly provides me with a lot of faith in this stock. So what is the verdict on Dollarama? Other than the liability asset balance, I do like what I have seen. They have a history of growth, and there are no signs of this slowing down. The bear market has had no to very little effect on their growth, and I suspect they are another of these recession stocks that will keep the green alive on those somber red days. Full disclosure, and of course those of you who watched my previous video already know this, but I have bought into the stock, and I suspect it may be a hold forever part of my TFSA. This is a good company, and I totally get why some of the community has been so bullish on them. I suspect more of the community after this video will be in heavy Dollarama research mode. The fun does not have to end here, because you can always watch my video on Pembina pipelines that I have linked up in the top left corner, or of course right below that, YouTube will show you a video they think you will like. Your click will decide who is right, and I will see you in the next video.